Good day, ladies and gentlemen, and thank you for joining us for our class on economic events and trading the news. Now, economic events are a great source of volatility. Therefore, they are a great opportunity to make profit. They're pre-scheduled, which means that we can take our time and do the right studying, the right preparations, and be ready to trade. We know what's going to happen. Trading the news or headline trading, you have no idea what Donald Trump's going to say or what's going to happen in the Middle East and what headline's going to pop up when and what's going to do. But economic events are all scheduled and they recur. Jobs reports recur, whether they're weekly jobs reports, monthly jobs reports, like the U.S. non-farm payroll report, the most important job report in the world, is the first Friday of each month. Well, if you know that and you've learned and how to prepare and you know exactly where to pull your data, you have that coming up month after month after month. Okay. And so we also have a way to evaluate them. We have historic information and we have our own little system. Now, I would appreciate it greatly if you would subscribe to my channel and either click the subscribe or hit the bell icon. I promise you we won't delude you with emails. Okay, you'll only be notified when I upload a new video. So please subscribe. It's very important to my standings. So let's talk about how to trade the economic news. Now, trading the news can be very profitable if you can correctly guess which way price is going to move. I used a big word in there, guess. That's a horrible way to trade, isn't it? I don't believe in guessing anything. Now, most traders have experienced this whipsaw effect when price goes up or down very quickly, and up quickly, down quickly, it goes all over the place and it ends up where it started. Okay, it's nerve-wracking and you can get stopped out in a second. Okay, you can miss your exit point. There could be no liquidity. There's too many things that could happen, but it could be profitable. There are also ways that you can trade these events either before or after to turn this into profit. But first you have to learn what the economics calendar is all about. Because remember, the economic events that are being released were not developed for the Forex market and surely weren't developed for online traders. These are economic events that are integral to every government and every business around the world. So when an economic release comes out, markets can react violently as traders enter and exit positions based on information. Some news releases are more important than others. For instance, like I mentioned, the non-farm payroll report or the inflation figure, or lately we've been looking at GDP. Now there's a good reason for this. The central bank announcements are critical because what drives the entire market is ultimately central bank action, raising and reducing interest rates, especially from the main central banks, quantitative easing, buying and selling of securities. All of these pieces of data actually fit into one big puzzle that is used to help the central bank decide what to do. Now, a lot of these interrelate to whole industries. Like in the US, we have the housing market, we have housing sales, we have mortgages, we have building permits, we have closings, we have new home sales, existing home sales, because all of this tells us something building down the road. If, for instance, you have sales and sales can be very high, but because we had a bad winter, building permits weren't pulled yet. So we're going to watch for when building permits are pulled, because when the building permit is pulled, that means the contractor, the constructor, is starting or planning to start building that home. Okay. We want to look at mortgages because the more people that are putting down contracts to buy a house, because the house doesn't count as sold until it's closed, but they're going out and getting their mortgages. So when we see building permits go up, we see mortgage rates go up, not the finance rate, but the amount of mortgages, we know that we're going to see an increase in new home sales and existing home sales because what? All the steps are being taken. A guy wouldn't be pulling a building permit if he didn't have a contract for the sale of that house. Then ultimately when we see new home sales and existing home sales, new home sales are much different than existing home sales. Existing home sales means somebody sold their house, somebody else bought their house. People moved on. Existing home sales, new home sales, means the entire construction business is working. They're buying copper pipes. They're buying cement. They're hiring people. So when we see home sales, we want to see where they are new or existing home sales. Okay? All of this ties back together and gives us some hint about the markets. Now, the economic counter is a fundamental analysis tool for traders to position themselves to take advantage of future currency moves. And you say, well, why would new home sales affect the price of Forex? Well, sure, new home sales, if they're really good, are going to affect everything from the stock for Home Depot, because people who are fixing up their homes or buying existing homes are painting the walls. They're fixing them up to prepare to sell them. Okay, if you bought a new home, where are you going to? You're going to go buy curtains, drapes, furniture. So those stocks will be doing well. Plus the contractors' stocks will be doing well. So the major builders, okay, but that's the stock exchange. But where does it flow down? Well, that means there'll be a bigger demand for copper, so the price of commodities, copper, will go up. Means the price of the US dollar, the value of the US dollar, will be stronger because the economy is doing well. Because people are only buying homes, what? When they have jobs and security. So the economics calendar, which is published daily, is the main trading tool for traders that use fundamental analysis. Now, we are excluding in this conversation stocks. Okay, I mentioned Home Depot and stuff, but stocks have their own set of fundamental information. They have their quarterly reports, they have their ROI, their profit and loss, and they're like a stock is like a whole country, and it releases its own data. Now, economic reports like jobs report have an effect on the stock market, has an effect on stocks. Okay, but it's different than the effect that Apple can do very well during a bad economic time, or Apple can do quite well if the US is doing poorly, if China is doing very well. Okay, so we need to look at overall sales. Or for instance, Amazon is booming during Corona, but if you were to look at the whole world, it's doing pretty bad. But you'd have to look at Amazon's their own fundamentals to see if the stock should go up, whether you want to buy, whether you'd want to sell, what price it should be. Now, believe it or not, there are a large number of amateur traders who ignore news events and economic releases completely. They concentrate solely on technical indicators and chart patterns. Then they wonder why the market spiked violently against them in the space of a couple minutes. Well, any trader, no matter who you are, no matter what you're doing, no matter how you trade, no matter how brilliant you are, no matter how secret, you got some secret, super duper information. You know, your brother-in-law works at Google, and he found out they're about to release this new product and send him through the ceiling. He's not supposed to tell you, but he told you, you're going to go buy Google. Okay, well, if you don't watch the economics calendar and aren't aware of the fundamentals, you can get stopped out of the market, and a good trade can turn into a losing trade. Because the same prime that you were so right about Google and it should be going sky high, Trump came out and did something crazy. Okay, well, you can never predict that. But on the other hand, the jobs report came out and it was terrible. Much worse than expected. So what happened was all the stocks crashed. They came back. Google came back 2 hours later after the market absorbed all the information. So the technical jobs were doing well, but an immediate crash. So what happened was you got stopped out, or maybe you entered the market at the wrong time. If you would have realized the jobs report was at 0800 this morning, maybe you would have said, well, you know what? I'll buy my Google, but I'm going to wait till 9 o'clock after the market's gotten through this event to make my decision. Now, economic data tends to be one of the most important catalysts for short-term movement. Now, trading the news is harder than it may sound. But like I said, the biggest advantage to it is that we can prepare ahead of time. You can do your research. You can do your prep. Okay. But we need to understand what we're going to do and how long the effect is going to last and what one thing affects another and what the whole cycle is. Now, we're not going to sit here and go through the whole cycle, okay, because that would take a very long time. We have whole classes on that. But let's talk about the economics calendar. Now, what I popped up on here is this week's economics calendar, and I've only highlighted the major events for this week. Now, all the events are rated into what we call tiers. Okay, these tiers are how volatile they are and how important they are. So we're going to concentrate on, let's pick one report here. I don't want to pick a central bank one. So we're going to concentrate on U.S. retail sales. Nah, that's not. I'm just trying to find one I like to talk about. Okay, let's go with. Okay, we have the Bank of Japan meeting next week, which is actually on Tuesday. And so we start out, we can look at the calendar. First thing we see is the time of the event. We get the first is the policy statement. Next, we get the actual interest rate decision, and they're almost simultaneous. And then we get the Bank of Japan press conference, which can sometimes be more critical to the market than any decision that was made. Okay. But because we know when these events are scheduled, we know that their impact is severe, we know they're going to impact the Japanese yen, okay, we can start making reports. Now, if we come to the right, we see a couple columns. Okay. All the way on the right, we can pull up the dashboard for this event. It's going to show us all about this event because this is going to give us where we can spend our time preparing. We can see everything that's happened in the past. Okay. We also then get the previous event. So we're going to look at the Bank of Japan and their last interest rate decision. Interest rates in Japan sits at minus 0.1%. Actually, you know what? We got to get off of this because it's not a good one to explain to you. So we're going to go down here to the European Zoo survey. It's an economic survey and it's put out by, it's a German report, and the Zoo Institute is a German name that's about 100 letters long, so I can't even pronounce it. But we look on the previous column, the previous time the report was released, which was last month, was at a 51. Okay. This time we're expecting a 60. That means a higher market sentiment, but we don't know what this report's about because we're just coming for the first time. So we have our time to do our research. So we can start reading all the articles about it. We can look about it. So the economic sentiment is published, and this is the name of it. The one I said is I had 100 letters long, and it measures the institutional investors' sentiment, reflecting the difference between shares of investors that are optimistic and investors that are pessimistic. We can take a look at what has been in the past and how it actually deviates, what its true range is, how it has an effect on each different currency. Okay, we can do all of our research. We can be prepared. Now, the story of this is the previous was at a 51. We're expecting 60. We're expecting it much better than it was last month. And this is where it gets complicated because the economics calendar is straight data. There's no analysis in here. There's nobody's personal opinion. It is straight data. And the markets are like big babies. So I'm going to tell you the story about your kids and their report cards. Okay, this is the story of the kids and their report cards. So if you think of an economic event like a report card or a grade on the economy, so you're sitting down with your kids on Sunday dinner and you say to your son, well, kiddo, report cards are due on Wednesday. How did you do? Or how do you think you did? Now, the first thing you know is your kid's pretty reliable. He gives you straight stuff. He's a good kid. He's a good student. So he says to you, Mom and Dad, remember last semester I brought you home 4 C's and 4 C pluses. Now, what is that? That was the previous, same thing as in the economics calendar. It's just a fact. Okay? Again, we're not saying whether it's a good report card or a bad report. It's just a statement of fact. He says, well, you know what? I think this semester I'm going to do a little bit better than what I did. I think I'm going to bring home all C pluses. Well, your mom and dad, this is your kid. You're thrilled to death. Okay. You say, good kiddo, thank you very much. You give him a little bit of a lecture. Less time on Facebook, less time playing soccer. Better improve his grades if he wants to get in university. But you're happy parents. Now, you haven't called the school and done analysis. Maybe they changed the bell curve or the trading curve or anything else. You haven't checked with anything. This is just straight shooting data. And he's giving you his expectation. Okay. Now, in the markets, we get the expectation or the forecast or the consensus about a week before. Now, it's the same thing about asking your kids. Now, all the data from the releasing agencies is hardcore data. But the forecasts come from forecasting agencies. Like you'll see, well, Thomson Reuters group of 100 economics predict this. Or Bloomberg reached out to 1,000 different, whatever, and this is their consensus. It's a survey. Now, this is where we come to the critical part. Your kid walks in the door on Wednesday, hands you the envelope with his report card, and goes straight out the back door to play soccer. You open up the report card, and what has he got? He's got straight B's. You're flabbergasted. Not only did he do better than the last report card, he did better than what you expected. And this is where it becomes critical. He did better than what you expected. Because this is what the market is. It's expectations to the reality. Now, you said to the kid, hollered out the back window, hey kid, you know what? We'll take you over to McDonald's for dinner and then we'll go over to the mall and you can buy that new soccer ball you want. Because you're thrilled to death. That's a pretty good report card and it was better than you expected. So you start putting dinner away and get everything ready. And what happens? The soccer ball comes through the picture window, shatters the glass. It's all over the living room. Now you're pissed. You holler out the back door. Well, kiddo, you better get in here and clean up the glass and call the handyman. We're not going to McDonald's and forget the ball. Well, this is exactly what happens in the markets. You can have one piece of information that's super good, and then something a few minutes later can turn it to super bad. Or can reverse the whole market. Lots of times just multiple economic events. Some headline can pop out of the air. But at that immediate moment, when he handed her the report card, you could have predicted the effect. Okay. Now, the biggest question is, how do you judge the effect? Because some differences aren't tradable and other differences are tradable. What assets will they affect? And is the difference between the expectation and the reality enough to cause a tradable scenario? And this is where you can build what we call your market matrix. It's where you can sit down and do your research. You can still say what the market is expecting, then what, or market neutral, and then figure out a range above and below that neutral effect that won't make a tradable effect on the markets. And then where that number should come out to that would give you a possible trade, whether it's to go long or to go short. And this is how you would build your matrix. Now, there are many other ways there's many ways to trade the markets. Some traders like myself, I don't ever stay in the market during an event. Okay, I will look for 4 hours before the event, and if I can see a route, like for instance, if we're expecting an interest rate increase and I can see gold falling, I will go into gold going short and be out of the market before the event happens. Because if the buyers or the sellers are pushing gold down in their expectation that we're going to see an interest rate increase, then they're not going to reverse course until that economic event happens, till the decision comes out. So I'll take a short-term profit in the move of the market and the sentiment before and be long gone. Or you can take There's ways to trade both sides of the market where you can set what we call an OCO trade. So where the price pushes up, it'll execute a buy. If the price pushes down, it'll execute a sell. You can set up all that in a minute. Or you can only wait 15 minutes after the event to enter the market. There are all different trading styles, but you can be assured if the markets miss expectation or exceed expectation, you're going to get a knee-jerk reaction. Okay? It's very hard to trade that knee-jerk reaction. But you could have entered the market before and thinking that the jobs report to be very good, so it's going to send the dollar up. And if you're right, well, you ride up the dollar and take the advantage. If you're wrong, you make damn sure, especially on an economics rate, you have a very short stop loss and you're out of the market with a small loss. But trading the news can be very profitable if you can correctly guess which way it's going to move. So you need to learn how to build a trading matrix. You need to determine what you think market neutral will be, and then find ways to gauge market positive and market negative ahead of the event. You can do this by building yourself a nice spreadsheet and dropping it all down. The name of the event, the day and the time, the ask. Because once you've done this and done your research, next month all you have to do is come look at the numbers and then drop them onto your schedule. Okay. And of course you can take the long-term effects. But since most of us here are CFD traders or day traders, we're not looking for a long-term result. So a novice trader, in turn, can use the initial period of his trading career for perfecting his money management skills, because you need to have excellent money management skills if you're going to trade economic events that can cause huge amounts of market volatility. But you can do this by observe prices leading into an announcement, identify support and resistance levels above and below the current price, set up your entry order points ahead of time. Make sure you've left enough room to account for some market swing in either way. You want to manage your orders. That's what I said. You can use complex OCO orders. You can use limit orders. Okay? And make sure you use stop losses. Because we are anticipating volatility in a fast-moving environment, it benefits us to add proper risk management parameters to our trades. We have to keep in mind that the number one mistake Forex traders make is risking too much to make too little. Despite lofty winning percentages, that type of inverse risk-reward ratios don't always allow for much success. Traders are right more than 50% of the time, but lose more money on losing trades than they win on winning trades. Traders should always use stops and limits and enforce important risk-reward ratios. Because there's all types of things that can happen. So there are many strategies and ways that you can set up to determine what to do. But it takes a little bit of time. It takes a little bit of education. It takes a little bit of experience. And the nice thing is these events happen month after month after month after month. Trade them on a demo account for the next 3 months. Figure them all out as they repeat each other and you get to know their personalities and how they affect the market. What assets? You can then start adding them into your trading scenario. You don't have to rush to do it. It's not a one-time opportunity. So remember, always risk management and risk reward is what you should always be looking at. Okay. So find the events on your calendar. Look for only the major events. Now you can sort your calendars and just tell it to only show you the major events. And slowly find a couple that interest you and then build your matrix. See how they work. See how they operate. Because like U.S. housing starts could be in the millions. You have no idea. Some things are report like CPI inflation is in tenths of a percent. So the variable between a good report and a bad report can be 0.1%. A variable in a jobs report could be 25,000 jobs in either direction. So you have to get to know these events. So you need to learn the strategies in detail. You need to practice and use what I call OVV, observation, validation, and verification. So take your time, and in no time flat, you'll be able to trade fundamental events and build your trading matrix. So thank you very much for joining us. And if you look around here on my YouTube channel, you'll find that we have all types of educational material and fundamental analysis tools that will break down all of these events. We'll show you how they all work together. We even have ones that show you exactly what to do on the non-farms payroll report or inflation. So thank you very much and have a great trading week.